Hi, my name is Brandon Beaver, and this is the Chinchilla Picking podcast. This is not the normal format. This is our very first episode, and normally we would be joined by the co-host and co-founder David Underwood. However, he is out this week, so you have only me. But you know what? You're getting in on the ground floor here. And what's better when you're doing stocks than being in on the ground floor? So the bad audio quality and the fact that I'm tripping over my words and the fact that I'm recording this on an iPad in my bedroom, you know what? That's just the cost of investment. You're investing your ears and your mind to be enriched by me and by Dave when he comes in. However, normally the format is going to be me and him talking about things that we have thought would be good for you to hear over the course of the week. There's going to be arguing, so you're going to hear me win a lot of arguments. But no, seriously, so it's going to be me and him, and what we're going to do is we're going to get together before these podcasts, introduce our topics to each other 20 minutes before we record. So what you hear is our fresh thoughts and our fresh opinions on the matter. But for right now, you get to hear me and only my opinions, which are very valuable. So consider the fact that you're hearing probably very bad audio quality. That is your cost of knowledge that I'm delivering to your earbuds right now. So let's get into this. In the past couple weeks, cryptocurrency has been in the news a lot, especially with the ascension of Bitcoin. It got to about $56,000 before coming right back down to 43, and now, as of this podcast and recording, we're around 50K again. There's a lot of crypto bulls, and then there's a lot of crypto naysayers. Less naysayers now, though. We're getting more to having more crypto bulls than naysayers. But one of the biggest naysayers for cryptocurrency has been Peter Schiff. Excuse me. If you know him, he sells gold. So I think the reasons for him being a crypto naysayer are rather obvious. But if you have the time, jump on Twitter, find his little beef and Twitter feud with Mark Cuban, because it's very interesting to me. Mark Cuban at one point was a crypto naysayer, but he's turned. And if you jump on Twitter and you look at this, Peter Schiff complaining about Bitcoin. Of course, it's eating into gold's market cap, so it's probably eating into his profits. And Mark Cuban says, "Let me help you out, Peter. Gold is dead." Now, that's an interesting idea. I'm not certain that gold is dead, but certainly Peter Schiff has reasons to be pumping gold over Bitcoin. Now, another crypto naysayer has been Kevin O'Leary, a.k.a. Mr. Wonderful. You see him on Shark Tank and CNBC all the time. And now he's allocating, I think he said 5% of his portfolio is going into Bitcoin. He's a rather rich guy, so 5% is quite a bit, actually. And on the other hand, you see the Federal Reserve is now thinking about going into cryptocurrency, which it reminds me that they have absolutely no idea why Bitcoin is so valuable. I mean, if you're getting into Bitcoin, if you're getting into cryptocurrency, you're doing it usually to get away from a central government controlled money. So what's the point of going into a Federal Reserve controlled crypto? There's no point to it. Bitcoin still maintains the advantage that there is scarcity and that there's only so many Bitcoin you can mine. It's not going to be printed into oblivion. Furthermore, in regards to gold, if you buy a ton of gold, if you're very wealthy and you buy a ton of gold, it's very scary. Like, what are you going to do? You're going to keep that in a room in your house so that you can be robbed for it? No. You're usually going to have to pay for storage of the gold that you own. But you don't really have to pay that much for the storage of Bitcoin. It just goes on a hard drive or a flash drive. Hopefully, you can remember your password to those things. I mean, you see on the news all the time these people that had tons and tons of Bitcoin and could be multimillionaires except for the fact that they can't remember their password to those flash drives. So if you have them, please remember your password, at least. Or don't be like the guy that back in 2010, he sold like 10,000 Bitcoin for 2 pizzas. Oh, that's gotta hurt. But yeah, the Federal Reserve thinking about a crypto. When you look at why people are buying Bitcoin, it's to get away from the Federal Reserve and the Treasury. No new technology intelligent person or libertarian or whatever you are is going to buy a Federal Reserve note that is a crypto. It makes no sense. Also, speaking of cryptocurrency, one guy that you guys should all go back and look at, he was a gem of a man. Rather hard to understand if you watch the YouTube videos and the interviews and things like that. Friedrich August von Hayek. He is was a Nobel Prize winning economist, famous for the Austrian business cycle, his contributions to that. I'm not going to get into that here. Maybe at some time in the future we might get into it when we're going back into talking about currency and things like that. But I recommend everybody looking into that. It's a great theory. I subscribe to it personally. But I do definitely, if you're interested in Bitcoin and why cryptocurrency is so popular right now, go back and read The Denationalization of Money by F.A. Hayek. It's a great book. It was written decades ago, I think in the late 70s. And it just talks about how money, if it was privately owned or privately printed or whatever, decentralized money would be a lot better than the dollar. And it lays out the case for, I think, the reasons why Bitcoin, so far into the future from where he wrote that, ascended to where it's at right now. Now, some people claim that Bitcoin is a hedge, but, until recent history, and even maybe now, it's been correlating with the S&P 500. I think this week, with the S&P having so much trouble as it did in the NASDAQ, and Bitcoin has actually remained relatively stable, which is very interesting to me. So are we decorrelating from the S&P 500 and the NASDAQ? It's an interesting thought, and if the theory that Bitcoin is going to be a hedge against inflation is correct, then it should decorrelate from the stock market, and that's a good thing, because then that will attract more attention from institutions and other Wall Street fat cats. And as the future goes on, I think right now you've been seeing a lot of cryptocurrencies correlate with each other. So when, Dogecoin, or better, Litecoin, Ethereum, things like that, when those are going up, often Bitcoin is going up, or more likely they're actually probably following Bitcoin. But at some point, if these currencies do what they're supposed to do and actually become competitive against each other and build off each other from that competition, those cryptos should actually decorrelate from each other as well. And that'll be interesting to see in the future which one wins out. Right now it's Bitcoin. In the future there may be something else that takes Bitcoin's place. We've seen a lot of people be very concerned with the environmental impact of Bitcoin, so maybe there'll be a new cryptocurrency that's more environmentally friendly. Only the future will tell, Now, we've also been seeing in the past month a lot of interest over Dogecoin. Will Doge hit $1? Probably not. But, it's not impossible. It's not impossible at all. A lot of people complain about Dogecoin, the fact that it doesn't have a limit as to how much you can mine. I'm going to be honest with you, I don't know much about the technology. But I can tell you that most of us don't know much about how the US dollar functions either. And yet we still use it. And if you look at last year's deficit, or rather debt, let's say debt, because the deficit's at 3.1 trillion. The debt is a lot larger than that. In fact, we have more debt in the United States than we actually have US dollars in circulation. So if you look at Forbes, for example, FY 2020, fiscal year 2020, government spending, $6.5 trillion. The amount of US dollars in circulation as of February 10th of this year, 2021, was 2.05 trillion. The government spending last year alone at 6.5 trillion. That is more than 3 times the amount of currency that we actually have circulating at the moment. That's insane. And so if you're looking at the value of Doji and you're scratching your head and wondering why, I think it's at like 5 cents now, it's been something crazy, like 1,000% jump in the value of Dogecoin in the past probably 12 months. That's why. It's not because Doji is incredibly valuable or that it has a high intrinsic value. It's because the dollar has such a low intrinsic value. It's more of a commentary on the falling faith of the US dollar than it is on Doji itself. Same thing with Bitcoin. Now, I like Bitcoin because of the scarcity. However, in relation to the US dollar, Bitcoin is also more of a commentary on the falling faith of the US dollar than it is on Bitcoin itself. Elon Musk he just tweeted about this a couple weeks ago when he said that if you know that the US dollar, and I'm paraphrasing here, if you know that the US dollar is dropping in value, you'd be a fool to not look somewhere else. Now, there's a lot of naysayers that say that, well, Bitcoin hasn't been much of a hedge. Except it has. Now, the US dollar has been falling. Of course, we've seen a little bit of a bounce back. In my opinion, it's a dead cat bounce. And you'll see that reverse. I think throughout 2021, the US dollar is just going to continue to drop and drop and drop. Now, look at the value of Bitcoin 12 months ago compared to now. I don't have the numbers in front of me, but I know for a fact that it's been insane how much that's grown. Gold has been relatively dead. So there's that, So if you're going to say Bitcoin wasn't a hedge, then certainly gold wasn't either, right? All right, moving on. Oh, wow, breaking news. Robinhood will be on the NASDAQ for its IPO. That's interesting. Now, I didn't get into the whole GameStop thing. I was more entertained by the whole fiasco. I did at one point put in some money into AMC, and then I got out of it pretty quickly. But it was a very entertaining fiasco, to say the least, watching the whole testimony to Congress over Zoom or whatever it was they did it on. But, yeah, Robinhood going ahead with the IPO despite the recent controversies. Well, moving on from that, though. Well, it was a tough week for the NASDAQ, wasn't it? Entered into a correction, 10% down from its highs. So, very stressful week for a lot of traders, even investors. It's a good time to go back to the basics. So, let's go over some rules for trading and investing. And I want to say this. Number one, if you're an investor, or you at least consider yourself as much of an investor, if you're generally saying that you are more of an investor than a trader, or just a complete investor altogether, let's say this. Investing and trading are two completely different things. If you are buying and selling in the same week or even in 3 months, you are not an investor. You're a trader. So don't pretend like you're investing, or don't think that way either, because you're not. All right? So if you're an investor where you're buying and holding for the long term, all right, and you see your portfolio as being entertaining, you're not doing it right. You're taking too much risk. It should not be entertaining. You should be reading all of the SEC reports, all the quarterly reports that your company puts out. You should be listening to the conference calls, the earnings calls, all that stuff, and quite frankly, it's boring. Unless you're interested in it, that's fine, because I kind of am, but still, it's boring. Trading can be a little bit more fun. Gambling can be really fun. It can also be really, really painful when you're losing. But investing is boring. It's not a bad thing. Okay? When you're investing, slow and steady wins the race. It should not be fun. Sorry for the paper moving here. Once again, part of the cost of you being in on the ground floor. You're welcome. Another rule. If you're making a ton of money, say 20 to 30% a week, hell, I see people on the stock Facebook pages showing that they made 20% in a day, which is crazy. It's awesome at the time. But let me tell you, if you're making a ton of money like that during good times, say 20% plus a week or a day, like I just mentioned, you're risking too much. And you will eventually lose most of your money. If you're one of those people, you might be turning off this podcast right now. You might hate me for saying this. You might say, I'm the best investor. I made 20% yesterday. But listen, be realistic. Do the math. If you're making 20% a week, what, do you think that's going to continue? Do you think you're going to be the richest person in the world? Because you're likely going to be a trillionaire if that continued. It's not going to happen. You're risking too much. Take the money and move on and be more conservative with it. Trust me, you will blow up your account if you do not. Now, if you're trading, you need to make sure that math, and this is another rule, by the way, you need to make sure that math is on your side. It's great to win 8 out of 10 times. That's awesome. But if you're losing all of your profits the 2 times you lose, what's the point? Now, if you position yourself with trades that win a majority of the time, and you put the same amount of money into each trade while setting stop losses, now say you find that you generally make 5% on each trade. Set your stop losses to 5%, and when you win, sell at 5%. In this case, all you got to do is win 51% of the time. Now, the goal would be to win more than that, hopefully. But you're still performing better in that position than the person who wins 8 out of 10 times and loses it all the 2 times that they lose. 51% is all you need to make money if you're doing it right and if you have math on your side. Also, my particular rule, I only trade stocks that I don't mind owning, okay? Because I trade on my phone. Sometimes it's on the computer, but you know what? I, like most people, I have a Monday through Friday job. Well, mostly Monday through Friday. But I have a regular job, okay? If my phone falls into a puddle, if something crazy bad happens, if there's a tragedy or something, God forbid, and I'm not paying attention to my brokerage, if I'm not looking at my phone, I want to know that I'm not going to lose half of the money that I put into the trades that I have. So I'm trading only stocks that I don't mind owning, just in case I have to. Because anything can happen. If you're in the middle of a trade, if you bought something and then something comes up that takes you away from your phone, you gotta know that your money is relatively safe. Now, let's talk about Warren Buffett a little bit. Last week he released the annual Berkshire letter to shareholders. Now, I gotta say something. I mean, the Money Vikings, that's our friends over at the Money Vikings have done an episode on this. They're very good. I recommend you going to their podcast. You can find it on iTunes. But they're great, and they go a little bit more into the letter that was released. But I think that after weeks like we had this week, heck, months like we had this month so far, it's always good to go back to the basics and look at what you should be doing regarding investing or trading, and just calm down a little bit, okay? So let's look a little bit at Warren Buffett's letter. One of the things that I thought was absolutely hilarious, he put this in the letter. It's a quote from Ronald Reagan. Wow. I don't know if I'll be able to edit that out, okay? Because I'm not very technology savvy at all. So, deal with it. I said Ronald Reagan. Whatever, okay? Like I said, cost of being in on the ground floor. What are you going to do? Anyways, the quote is this: hard work never killed anyone, but why risk it? And he put that in there. And here's the point of investing. The whole point of investing is putting your money into good companies with competitive, durable advantages so that your money works for you and you don't have to work for it, right? So that's a great quote. Another thing that he says here, bonds are not the place to be. I'm going to say that again because this week has been crazy. Bonds are not the place to be. Doubt anybody from CNBC is listening, but I'm going to say this to them too. Bonds are not the place to be. Tech is not dead, okay? It's not. Anyways, so he said bonds are not the place to be. So look at the 10-year rate. It's fallen from 15.8% in the early 80s to right now where it's sitting is 1.55%. Okay? That's not high. We may have had a crazy trajectory, and the way the bond yields moved from less than 1% to 1.55%, where they're at today, in my opinion, an overreaction to the situation that we're in economically. Okay? It's crazy. Tech's not dead. Tech wasn't dead a year ago, okay? In January of 2020, the 10-year rate traded around 1.8%. As of recording this podcast, we're at 1.55%. Now, was tech dead in January of 2020? Oh, no, that's right. It was still in a bull market. We were still moving up on tech at 1.8%. And the reason why tech was going up in January, let's talk about the fact that the earnings are great, and Apple's an amazing company, Amazon's an amazing company, Facebook's an amazing company, and all those great things. That's really the reason why it's up. But one of the reasons why it was given back in January of 2020 was that the 10-year rate traded around 1.8%. And so you're going to tell me right now that 1.55% is too high for tech? Come on. Not even close. So, really, if you have your mind about you, you're not listening to the crazy rhetoric, the sky is falling, fire is coming out of the sky, craziness from CNBC, Bloomberg, or whoever. Right now is your buying opportunity, okay? In the good blue chip stocks. I'm not talking about the speculative ones that aren't making any money. I'm talking about your Apples, your Amazons, your Salesforce. God, I love Salesforce, okay? Doubling their revenue in 5 years from now, that's awesome. That's their goal. They're doubling it 5 years. Their income statement is Awesome. They're building an empire, okay? And Apple's no different. Apple's 5G, okay? That's this year. Their catalysts are not over. So what I'm saying, buy big tech. There's going to be a point where these interest rates calm down and everybody comes running back to tech, and I think you need to be there before they do. That's my personal opinion. I don't know if, maybe Dave will come on next week and he'll have a different idea. But for me, that's what I'm looking at. That's what I see. Anyways. Oh, and then talk about the market efficiency theory. Oh, I hate this. It's the worst. When these fund managers come to you and tell you, well, if you've thought of it, the market already has it priced in. Nothing could be further from the truth. The market efficiency theory, that's what that is. That once you thought about it, once you had the idea to buy it, most of the time the market's already got the idea and it's already priced in. It's not true, okay? The market is not that efficient. In fact, to be honest, the market oftentimes is an idiot. And you can take advantage of that, okay? Look at last year. Going into COVID, going into the lockdowns that we had, and we were working on stimulus, and we were working on unemployment and extensions to that. And Amazon, when we started shutting down, Amazon dropped, okay? So people last year, and institutions, sold Amazon when we thought, and we did wind up doing this, we were all going to be stuck at home with money coming to us from the government. And you sold Amazon? Tell me the market's efficient. Because over the long term, maybe, but these opportunities come, and there's no reason for anybody to tell you that you can't pick individual stocks. If you put the time and the due diligence into it, you'll be fine. Okay? And these people that are selling you these 401ks and IRAs, they're made up of individual stocks too. So if the market efficiency theory was correct, then there'd be no point to even talk to them either. Going back to bonds, look at the 50-year historical chart on the 10-year and tell me that bonds are not dead, because they are, okay? I mean, you just mentioned that they fell from 15.8% in the early 80s, and now we're down to 1.55%. We're trading lower than we were in January of last year still. Now, they're dead. They're not the place to be, okay? Now moving on to another part of, and this is just something that I found interesting. I don't think that Pilot is a publicly traded company, but if you've ever been on a trip, especially if you go down south or wherever, oftentimes it is a part of your routine to stop at a Pilot store. They have great coffee. Hey, you know what? We don't have any sponsors right now. I mean, maybe we will by the time this is recorded. Pilot's definitely not a sponsor, but I love Pilot. My girlfriend, Lindsay, she loves Pilot too. We always make it a point to stop there and get their coffee. And I found it interesting that Berkshire is increasing their ownership of Pilot travel centers from 38% to 80% by the year 2023 because they've got such great confidence in Pilot. Started decades ago, by the way, by a man, and I can't remember his name right now. Mentions it in the Berkshire Hathaway report, but it was started by one small fuel station, and if I remember correctly, it was purchased for $6,000 or close to that. That's pretty awesome. Very large business now. All right. Also, ownership of Apple is increasing via share buyback. So Berkshire is not selling Apple. Neither should you. They're increasing their ownership. They're not selling. So if we're going to talk about Warren Buffett in the letter, I want to mention this. There's a book, and it's by Mary Buffett and David Clark. It's called Warren Buffett and the Interpretation of Financial Statements. I think every investor should read it, okay? And it talks about basically how Warren Buffett picks his stocks. And this is, once again, this is about going back to the basics. Go to the Oracle of Omaha, all right? Warren Buffett was a student of a man by the name of Benjamin Graham. He wrote a book called The Intelligent Investor. It's a good one, too. All right. I like Warren Buffett better than I do Benjamin Graham, but it's still a good book, especially if you're trying to get like an idea of how different people think about the stock market. Now, Benjamin Graham, he was the father of value investing. What he would do is he would go and buy stocks that were currently down, sell them when the market revalues them upward, but if they're not up within 2 years, he would go ahead and sell them, take the loss, okay? You can get on Google, you can look at the Benjamin Graham intrinsic value formula. There's a revised intrinsic value formula as well for modern day stocks. It takes interest rates into account and all that. I'm not going to go into the actual formula here. It's a bit complicated, but really once you start using it, then it's not so bad anymore. I don't really care too much for it. It's something that helps you select stocks. Okay, so what you run this formula, and then the rule is that you buy stocks that are under 20% of the value that the equation gives you. Now, if you do that, I have to tell you, your choices are going to be limited. Okay? Not always a bad thing. It's not bad to, you don't want to overtrade or overinvest. But if you only did this, okay, you would have missed a lot of opportunities. You would have missed Amazon, Apple, and Tesla, etc., because they wouldn't have fallen under that rule. You would have fallen for value traps, okay? If you go back about, I think, probably 6 or 7 years. I don't know if you've been in the stock market enough, you might remember when Micron was a value trap. The PE was regularly around 4 or 5, which is crazy low, okay? And so you would see that PE of 4 or 5 and be like, oh my gosh, this is, it's a great company and it's trading at 4 or 5. It stayed like that for years. So what you would have done using this formula in Ben Graham's rules, you would have bought Micron. And recently Micron's went up, but you would have sold it before then. You would have bought Micron, your money would have stayed flat, and you would have missed the run because you didn't hold it long enough. Okay? You would have also bought and sold banks like 1,000 times by now. And until recently, you wouldn't have made any money. So what you have to realize here, okay, value, by and large, is subjective. So oftentimes, really reading like the 200-day moving averages, 150-day, whatever you want to go by, that's usually a little bit more effective, in my opinion. Value does matter. We see it this week. Value does matter, don't get me wrong. But it is also subjective. And I think that's the hard thing for a lot of traders and investors, especially that are new to this, to realize that there's no right answer until the market tells you what is right over the long term. And even in the short term, especially in the short term, the market can be wrong. And it's your job to figure out when the market is wrong and to be ahead of it before it corrects itself. That is how you become a great investor or trader, whatever you are. All right. So Warren Buffett realized this, okay? And what he came to the conclusion he came to is that he doesn't care too much if a stock is undervalued or fair value. Now, he doesn't want to pay too much, but undervalued or fair value, if the company is good and has a durable competitive advantage, you can buy that company or that stock and just hold. There's companies that Berkshire has held for 50 years. I think Geico might be there. Coca-Cola, I believe, bought in the early 80s. Ben Graham would have sold them a long time ago. But Warren Buffett has become the world, well, Elon is encroaching on this, but at least one of the world's wealthiest men because of the way that he has started selecting stocks. So if a company is good and it has a durable competitive advantage, you can buy and hold the stock, okay? You don't have to time it so much. Now, you don't want to buy too high, okay? Because the lower the stock price is, the lower the risk. Which also means that if you currently own a great company, like I believe Salesforce is, not trying to push Salesforce too much, but Salesforce is a great company. Apple's a great company. Facebook, Amazon, Google. If you own these companies and they come down in price, you should not freak out and sell. Instead, you buy more. And guess what happens? When you buy more at these lower values, you are lowering your risk because you're buying at a lower price. You're putting more money into it, so kind of, you're putting more risk into it in a way, but it's always a better opportunity to buy low. It sounds like it's very obvious, but trust me, if you get into a panicky mindset and you're paying attention to the media too much, then it's a little bit harder to recognize this when you're actually in the stock or in a trade or whatever. The lower the stock price is, the lower the risk. Stocks you own from great companies, when they go down, it's a great opportunity. Not a bad thing in the long run. Okay? So when you're looking at what companies you want to buy, what you want to pick. This is if you're a Warren Buffett kind of investor where you're going to buy and hold. You want the profit margin to be higher than 40%. So take the revenue, divide it by the cost of the cost of selling, and higher than 40%, that means this company has a durable competitive advantage. Consistently growing revenue, very important. Lower research and development cost when compared to other competitors. Very important. Unique product or service, that's very important as well. These companies should have a unique product or service. If you're looking at Salesforce, for example, I don't mean to keep pushing them. If you're looking at Salesforce or any other company that is on the markets, top of mind, unique product or service is very important, and they need to have a top of mind brand. So, for example, what do you think of when you think of soft drinks? It's Coke or Pepsi, right? Fast food, it's McDonald's. Pizza, Domino's, maybe Pizza Hut. But a top of mind brand is very important. And I got to tell you, one of the best ways, you could just go and look at the income statements and the balance sheets and the SEC filings, and you can get these for free on msn.com. You can also use Yahoo Finance. And this is the basics of this, but it's very important times like these when, it's easy to panic, go back to the basics, and calm down, That's it. That's all I have for you today. I don't really have a show exit. We don't have any theme music. No sponsors for right now. We might in the future. I don't know. I have to tell you, I am not a licensed financial professional. I did mention Salesforce quite a bit, but I think you need to consult a licensed professional in regards to your finances. I'm not one of those. I'm giving you ideas, that's it. That's what we want to do. We want to help you with your strategies, trading and investing, and hopefully you've gained a decent amount out of this episode. If you haven't, I'm sorry about that. Maybe you'll get more when David comes by next week. Dave I gotta tell you, I'm more of a blue chip guy. I trade blue chips, like I said before, when I trade, and invest in them as well when I invest. And those are my thing, like the Apples, the Amazons, the Googles, the Facebooks, so on. You've heard me mention them numerous times throughout this podcast. Those are my thing. I think you're going to get a lot out of David, too, because he likes penny stocks a lot more than I do. So if you're into that kind of thing, you definitely need to listen next week, because that's his thing, it's not mine. So, but I hope you have a great week, and man, I hope the market gets better, because this week's just been crazy. But stick to the basics and you'll be fine. Have a good week.